This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices sharply higher this morning. This is directly due to comments from the president of the Chicago Fed when he said that raising interest rates could be a catastrophe if they were raised too soon. At least that was the implication. So it now looks like the Fed could be leaning more toward raising rates later rather than sooner. We also feel that even though we do have these geopolitical problems continuing, especially in Greece and to some degree now elsewhere in the world, that those negatives will be outweighed by the bullish influence of low interest rates. Also, it does appear that the European Central Bank is on track for a new quantitative easing program, possibly at their upcoming meeting later this month. So in any event, stock index futures continue to be supported by globally very low interest rates and prospects of even lower rates, and that is likely to continue well into this year. Over in the currencies, seeing the dollar index advancing to a new 9-year high. Also, we are seeing the euro currency falling to a 9-year low as factory orders came in weaker than expected in the Eurozone. Also, prospects of more stimulus from the ECB at the January 22nd policy meeting continuing to undermine the euro currency. Also seeing some pressure in the pound with the Bank of England holding rates unchanged at 50 basis points, which is a historic low. But there's more and more talk that the Bank of England will be forced to delay a rate increase. They probably will not be able to raise interest rates this year, as many had predicted earlier, and they now may be forced to wait until 2016 to increase interest rates. So that continues to be a negative on the pound. The yen lower, as flight to quality longs continue to be liquidated now for a second day. So from here, I would look for higher in the dollar, probably lower in the euro, lower in the pound, lower in the Japanese yen, and interest rate markets under some pressure at the long end. These dovish interest rate comments from the Chicago Fed Bank president tended to support the front of the yield curve over the back of the yield curve. However, I think this is likely to be just a temporary situation. Longer term, it should be the 30-year bonds that lead this market to the upside. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.